Assalamualaikum warahmatullahi wabarakatuh. We are from Group MAC603. We'll be presenting our solution for online group project MAF603. So our group members consist of 5 students, which are Nelly IZZATI, Nur FATIN DAMIA, Suhana, Nur NAJAAHTUL and Nurul Amani. So let's proceed with the first case. New waves of the COVID-19 outbreak in major parts of the world may have sparked fears of a double-dip recession. But Trademark Auto Berhad, the official distributor of Mazda cars and spare parts in Malaysia, remains optimistic that the global economic growth is on track. Due to that, Trademark Auto Berhad is considering 3 possible financing arrangements to raise 100 million ringgit of new capital for its business. The first alternative is finance with only new equity. The second one is finance using 50% debt and 50% equity, and the last one followed with finance using only new debt. The proceeds may be utilized to finance working capital requirements, investments, acquisition, capital expenditure, and general corporate purposes. Currently, the capital structure consists of no debt and 250 million ringgit in equity. There are 100 million shares of common stock currently outstanding, selling at 2 ringgit and 50 cents per share. Expected earnings of 200 million ringgit before interest and taxes are expected for next period. The interest rate on any debt obtained should be 10%. So let's look up at the requirement. The first requirement is to calculate the earnings per share for each alternative, and the second one is to determine the distribution of income between debt holders, shareholders, and the government for each alternative. And here are the solution for 1A. For alternative 1, finance with only new equity, here are the information given. Debt equals to 0, equity, which is S, equals to 250 million ringgit plus with 100 million ringgit, which sums up to 350 million ringgit. EBIT here is 200 million ringgit, and price per share is 2 ringgit 50 cents. Here are the formula of value, which is B plus S. Since we have no debt here, 0 plus 350 million ringgit equals to 350 million ringgit. And the shares outstanding here is 250 million ringgit plus with 100 million ringgit divided to 2 ringgit 50 cents comes to 140 million shares. And here are the answers for earning after interest. Since for alternative 1, it got no debt, so which means we have no interest too. So 200 million ringgit minus with nothing equals to 200 million ringgit. So the answer for earning per share after tax is 200 million ringgit divided with 140 million shares times 1 minus tax, which comes out with the answer 1 ringgit and 7 cents. For the second alternative, finance using 50% debt and 50% equity. And here are the information concluded. Debt equals to 100 million ringgit times 50%, which comes out to 50 million ringgit. For equity, 250 million ringgit plus 100 million ringgit times 50%, which equals to 300 million ringgit. Sorry, there's a typo here. EBIT, 200 million ringgit, and interest for debt 10%, and price per share is 2 ringgit and 50 cents. For the new value here, debt plus equity, which is 50 million ringgit plus 300 million ringgit, which totals to 350 million ringgit. For shares outstanding, 350 million ringgit divided with price per share 2 ringgit and 50 cents, which comes out to 120 million shares. So for the earning of interest, since there is debt here, 200 million ringgit minus with debt, which is 50 million ringgit, times with the interest rate 10%, and the answer goes to 195 million ringgit. So for the earning per share after tax, 195 million ringgit, which is the earning after interest that we calculated earlier, divided with 120 million shares times 1 minus tax. So the answer is 1 ringgit and 22 cents. Okay, let's look up for the last alternative, which finance using only new debt. And here are the information concluded. Debt equals to 100 million ringgit, equity equals to 250 million ringgit, and EBIT as usual 250 million ringgit. Rate for interest for debt is 10%, and price per share or share per price is 2 ringgit and 50 cents. So here are the new value and shares outstanding. For the new value, 100 million ringgit for debt plus with the equity 250 million ringgit totals up to 350 million ringgit. The shares outstanding 250 million ringgit divided with 2 ringgit and 50 cent, which comes up to 100 million shares. And for the earning after interest, 200 million ringgit minus with 100 million ringgit times 10%, which calculate to 190 million ringgit. So for the earning per share after tax, their earning after interest earlier is 190 million ringgit divided with their shares outstanding, which is 100 million times 1 minus tax, which comes up with 1 ringgit and 43 cent. Okay, finish for the A answer. Let's follow with the second requirement, which is distribution for the income. For the first alternative, the EBIT is 200 million ringgit. Since there is no interest, so the earning after interest comes out with the same amount of EBIT, which is 200 million ringgit, minus with tax, we will get earning after tax, which is 150 million ringgit. So since there is no interest here, only shareholders and government will get the income. So the shareholders will get 150 million ringgit and the government will get the tax, which is 50 million ringgit. Followed with second alternative, 200 million ringgit minus with interest 5 million ringgit. We will get earning after interest, which is 195 million ringgit. So to get the earning after tax, we must deduct with the tax, which is 48,750,000 ringgit. So the earning after tax is 146,250,000 ringgit. Okay, so since the debt and the equity is apportioned to 50%, shareholders and debt holders will get the same amount, which is the earning after tax divided with 2, that comes out to 73,125,000 ringgit each for shareholders and debt holders. As for the government, they will get the tax amount, which is 48,750,000 ringgit.
Question B, Alternative 3, the distribution of income between debt holders, shareholders, and the government. The same calculation as before, starting with EBIT, 200 million ringgit, minus by interest, 10 million ringgit. How do we get 10 million ringgit? It is by interest rate of 10% times 100 million ringgit, and we will get the EBT of 190 million ringgit. And then we minus tax for 7.5 million ringgit, which is 25% tax rate times EBT, and we will get the EAT of 142,500,000 ringgit. And now we can distribute the income between debt holders, shareholders, and the government. Debt holders 57 million ringgit, we can refer to the working one. And for shareholders 85,500,000 ringgit, we can refer to the working two. And as for the government, the same as before, it is equal to the tax amount. And now, let's proceed with the question C. In this question, the corporation agreed to issue an additional debt of 60 million ringgit, resulting a debt to equity ratio of 1.5 for the purpose of increasing its capital requirement. By applying proposition, calculate the value and overall cost of capital of trademark Autoberhide. Let's calculate the value, or V, of the company first. Stated in the question before, the current capital structure consists of no debt and 250 million ringgit in the equity. Therefore, we can see that the B is nil and S is equal to 250 million ringgit, comprises of 100 million number of shares times 250 cents ringgit per share. And by using the formula V is equal to B plus S, the current value of trademark Autoberhide is 250 million ringgit. By having this information, we can calculate the value of RO by using the formula of unlevered firm, which is VU, EBIT 1TC divided by RO, and we can get the RO of 60%. And stated in the question, the company agreed to issue additional debt amount of 60 million. Therefore, we can calculate the value of the firm after by using the formula VL is equal to VU plus TCB. And we will get the value of the firm of 265 million ringgit. And now, the overall cost of capital or RWACC, we can calculate it by using the formula VL is equal to EBIT 1 minus TC divided by RWACC. And we will get the overall cost of capital or RWACC equal to 56.6%.
So, we move to the next question where D explain why debt level vary across sector and within industry. So, the debt ratio is a financial ratio that calculates the size of the company leverage. Debt ratio is defined as the ratio of total debt to total asset, expressed as a decimal or percentage ratio. It can be defined as a proportion of asset of a business funded by debt. The higher the debt ratio, the more the leverage of the company, the higher the financial risks. At the same time, leverage is a various tool that companies use to expand, and many businesses are seeking sustainable debt uses. For various sector or industry, the nature of the company to different as a result of which the debt demand of company is different. The debt ratio of 30% might be too high for a business will violate cash flow, in which companies have a little debt. A business with a high debt ratio compared to its competitors would probably find it difficult to borrow and could find itself in this current circumstances changes. Conversely, a debt level of 40% can be easily handled by a business in sectors such as telecommunication where cash flows are stable and higher level of debt are the norm.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nurul NAJIHAH binti BAHARUDDIN. I'll be presenting case number 2. Randy Property Berhad is planning to invest in a project which will involve diversifications into a new industry. Due to rising health in cases nowadays, Randy Property plans to increase business focus in the industry related to healthcare that is on the diagnosis and remote monitoring of heart rhythm disorders. It will become part of Randy's connected care business, which offers a range of platforms and devices that allow patients to stay at home while being monitored. With the management of Randy Property Berhad expected to deliver double-digit growth and improve its earnings before interest and tax to more than 20% by 2025. The finance manager of the company has analyzed two companies that are identical in every respect except for their capital structures. Their market values are in equilibrium as follows. So this is the information for the both company, which is gear company and ungeared company. The total value of gear is higher than the total value of ungeared, which is consistent with Morgan Stanley Miller. All profit after tax are paid out as dividends, and so there is no dividend growth. The beta value of ungeared has been calculated as 1.0. The debt capital of geared can be regarded as risk-free. A. Calculate the followings. Roman 1. The cost of equity to the equity holders in the geared and ungeared company. For the geared company, in order to find the RS, we have to find the RO first. Therefore, I'll be using the formula of VL equals to EBIT, bracket 1 minus TC, close bracket over RO plus TCB. VL is 8.08 million equals to EBIT 1 million times by 1 minus 0.25 over RO plus the debt that will be given in the equations, which is 4.18 million times tax rate 0.25. Therefore, RO is 0.1066 or 10.66%. After we have find RO, we can find the cost of equity, which is RS. RS is equals to RO plus B over S times RO minus RB times 1 minus TC. For the RO is 0.1066 plus open bracket debt 4.18 million over equity 3.9 million close bracket open bracket RO 0.1066 minus RB 0.08 close bracket times the TC 1 minus 0.25. Therefore, RS for the geared company is 12.80%. Move on to ungeared company. By using the same formula, VL equals to EBIT times Y minus TC over RO plus TCB. VL for the ungeared company is 66.6 million equals to EBIT 1 million times by 1 minus 0.25 over RO plus TCB. There is no debt given for the uncapped company. Therefore, for the debts will be 0 times TC 0.25. Therefore, the RO for the uncapped company is 11.36%. Since there is no debt for the uncapped company, hence RO is equals to RS. Next, Roman 2, the beta value of GAT using the asset beta formula and explain the calculated beta. In order to find the beta value of GAT, we must calculate the ungapped beta first. Step 1, calculated asset beta or ungapped beta. Since the ungapped beta has been provided in the questions, which is 1.0, we will jump to the step number 2, which is calculated equity beta or GAT beta. By using the formula, asset beta equals to equity beta times value market of equity over value market of equity plus market value of debt times by Y minus TC. After calculating, equity beta for the gap or the equity beta or gap beta is 1.80. To explain the calculated beta, the asset beta is positive, so investor will invest in the company stock when prices are expected to rise. For levered beta, if it is greater than 1 or less than -1, which means it has a greater volatility than the market. Therefore, the stock are influenced with the day-to-day market news and spread very fast due to heavy trading happening in the stock, which market is volatile and attractive to traders. That's all from me. Thank you.
Next, leverage effects and the implications to companies if earnings are insufficient to cover interest obligations. First of all, leverage is referring to the amount of debt financing for a company uses. As the leverage will increase risk of companies, so companies' returns in terms of equity will be decreased. Hence, the amount available to be distributed as dividend to shareholder will be substantive since the balance risk increase. This situation matches the basic economy theory, which is high risk, high returns. For the consequence, company will have difficulty and less efficient in making profits and increasing shareholder value. Therefore, the implications from the insufficient earnings to cover interest obligation is company need to spend some of its cash reserve. For instance, interest coverage ratio below 1 indicates the company is not generating sufficient revenues to satisfy its interest expense. If a company's ratio is below 1, it will likely need to spend some of its cash reserve in order to meet the difference or borrow more. Secondly, lenders will likely refuse to lend the company more money. It's happened when the company that have a bare minimum acceptable ratio and the low tipping point because of the company's risk for default may be perceived as too high. So the lenders will likely refuse to lend the company more money. Lastly, the company will risk falling into bankruptcy. This is because companies need to have more than enough earnings to cover interest payments in order to survive future financial hardships that may arise. A company's ability to meet its interest obligations is an aspect of its solvency and is thus a very important factor in the return of shareholders. Otherwise, even if earnings are low for a single month, the company risks falling into bankruptcy. Next, see the relationship between financial distress and capital structure and consideration to be addressed by using debt financing. So, first of all, financial distress is a condition in which a company cannot generate sufficient revenues or income, and it will make it unable to meet or pay its financial obligations. Meanwhile, capital structure is the particular combination of debt and equity that the company used to finance overall operations and growth. So, the financial distress will occur when the company increases the amount of debt. For the consequence, it will decrease the equity of the company. So, The considerations to be addressed by using debt financing is the debt financing must be paid back at some agreed date in the future. Next, debt financing can be difficult to obtain, but for many companies, it provides funding at lower rates than equity financing. Then, if the company goes bankrupt, lenders have a higher claim on any liquidated assets than shareholders. Last but not least, the interest on the debt is tax deductible. Even so, adding too much debt can increase the cost of capital, which reduces the present value of the company. That's all from us. Thank you.